Hey guys, in this video I'm going to cover the no-lose 1-1-2 strategy, and when I mean no-lose, I'm not going to guarantee returns. I just mean you're going to win 99% of the time. So you're going to virtually have a no-lose strategy, and let me walk you through how this works. This is something I've been researching and looking into even when I started trading 1-1-2s, but especially this week because of Monday. Monday, the market dropped a lot. Not only that, but VIX spiked up a lot, which increased our buying power usage and kicked us out of a lot of trades. And so I want to know, how can I prevent this from happening again? Are there any practices that I could have put in place? And the truth is there was, and there is. I thought about this before the market crash, but again, you never truly understand it until you go through a crash event. So let's walk through how you can set up a 1-1-2 to almost never lose. All right, so a 1-1-2 strategy, if you don't know what it is, it's a very great strategy that allows us to take advantage of the market when it's going up and down. So for instance, we're going to have two short puts that we sell all the way, oops, my bad, trying to draw here. Two short puts that we're going to have like all the way down here or something like that. We're going to have a put debit spread, and this creates a scenario where if the market goes up, we make money. So that's kind of the scenario. If the market slowly goes down into this range, we'll make probably 3 to 4 times what we normally make. And then if we start to break down below our short puts, we'll lose probably 3 to 4 times depending on how much it goes down. So this is a 1-1-2 trade structure, and it's a very reliable trade, except for when VIX spikes to infinity. And so again, if we look at that, that's where the recent issue has been. VIX spiked all the way up to roughly $65, $66 in the matter of a single day. Now, this was because of Japan, but regardless, that is what knocked us out of a lot of our 1-1-2 trades, when the truth is it reset literally the same day and even the next couple days. And now if you were still holding on to the 1-1-2 you had, you would be up money or almost back to break even. So for all those who who closed out of our positions, yes, we took some risk off the table, but still we would be back to break even. And so how can we do this? And so it all comes down to buying power. A lot of people were over leveraged. And so again, buying power is our ability to stay in a trade and see it through, right? If our buying power usage, because we're trading futures, that means buying power goes up as risk goes up, aka as VIX goes up. And so I saw my personal account, and again, I see trading stats of 1-1-2s of over 150 people, verified results. And what I saw is that the buying power required in this time went up 100 to 150%. That means that if you had 50% of your account in a trade, you would have had to close a position. So what does this mean for you? This means that the generic 50% rule helps mitigate risk, but it is not a one-size-fits-all approach. And so this is how I would recommend to look at sizing for 1-1-2s from here on out, so that you can stay in those trades and then be back to break even and then make some money on these 1-1-2s instead of having to get stopped out like I did. So here is the game plan, all right? So if we're looking at VIX, you can see here it's almost never above 40, and we typically trade here around $10, $10 to $15 when the market is very low. So here's my game plan, right? If we're at $10 to $15, what I'm going to be looking to do is only be using 25% of my buying power. Does this make sense? This is where VIX has the highest likelihood of increasing. What I mean by if we were trading here and then VIX went up to here, and this is why buying power increased by 100 to 150%. But if we're only using 25% of our buying power in this zone, we're not going to be affected by that. If it increases by 100%, well, now we're only using 50% of our account, or even 150. We're only using 75% of our account. So we can hold through this trade, allow the volatility to reset, and then we'll be good on our 1-1-2. So again, you'll make less money doing this, but if you only allocate 25% of your account to 1-1-2 trades, when VIX is this low, that's going to help save you a lot of money and allow you to stay in these trades longer. Now, if we're between 15 and maybe we can go like 30, again, this isn't a solid back-tested number. We can always go like 15 to 25, a $10 range. In this range, we could be 50% of our buying power. Why? Well, because the future span margin that we use calculates and factors in the risk of the market already. So if I enter in a position around here, the risk is already built in to the pricing of what I'm doing for that trade. And so 50%, the likelihood of it increasing here is maybe only a 50 to 100% increase in buying power. And if I'm only using 50% of my account, well, then I'm good. Okay, and then again, anything above here, you can go up theoretically to 100%, right? Again, not something that I would recommend. So we can simply break it down into two levels, which is 50% above $15 or 25% of my account below 15. So if that's the way we're looking at it, that's how you can create a no-lose strategy. Now, I may be like, Austin, well, volatility is still an important factor and I'm going to have stop losses, right? Well, actually, you can just remove your stop losses. So why? Well, again, this is going to knock you out of a lot of crazy events. So something that you could do is remove a stop loss, so go no stop loss, and instead just hold the trade through, and most of the times you'll be fine. Or if you really want to have a stop at the break of your short strikes. So short strikes, I'll just do ST for short strikes. And so what does this look like? Well, let's go back to SPY here for an example. Let's say we're trading, we enter the trade right here. That put our short put here. That means that if the market comes down and breaks our short put level, then we exit the trade. Why? Because at expiration, we're only going to lose money if our put is below this level, and so, or below our put level. And so again, if it breaks our two short puts, that's when we can exit the position. But if you're just going from a purely no stop loss, you just increase your win rate up to 99%. Now the only other risk factor of a 112 is the buying power increase. And so if you use VIX levels to determine how much buying power you're going to use, this helps you out a ton. So how do you do the no loss 112 strategy? Well, here it is. 112 strategy looks like this. You're going to buy a 25 delta, and then sell the 23 delta. This is going to be your put debit spread. You're going to sell 2 times 7 delta. This are your short puts, SP for short. So again, buy 25 delta, sell 23 delta, sell 2 of 7 delta. And then again, how you're going to size in is determined based on where VIX is trading and based on how much buying power allocation you can use. And then again, if you don't have much money, you can do MES, which again, you have to be aware of. You have all this volatility risk because there's less liquidity there, so you might have issues with that. Or you can do ES. And so again, here are 2 ways to do it. If you still want to do this same type of structure, but you don't have enough money, you can go on either ES or MES and do a 1-1-1 instead, which is going to lower your buying power by about 50%. All right, guys, I hope this helps, and I hope this makes sense of how you can structure the 112 based on buying power rules to kind of turn it into a no-loss strategy, or virtually no loss. There's nothing guaranteed in the market, but I hope this video helps and gives some direction on how to allocate your funds. All right, guys, if you enjoyed this video, please smash the subscribe button, and I'll see you in the next video.